Okay, it looks like we're live. Let me finish sending the link out and we'll get started. Quick stream tonight. A lot of stuff at my day job working on, so quick streams all I have time for tonight. But just to follow up with what we talked about with HEX the other day. It's been an exciting weekend for HEX, and as the price is pumping, another thing happened in the crypto space that just kind of showcases the some of the things we've been talking about on this series about why HEX has just like a different risk profile than other types of assets or DeFi protocols that allow you to earn interest or earn some type of yield on your investment. And so it's always good when we see these things actually play out in real life, because we always talk about that HEX, might be the risk-free yield farm, where by risk-free meaning the one where the only risk is the price of the underlying asset, only limiting the risk profile to being the exchange rate risk. It actually frees up that asset to be able to, if you're reducing risk in other areas, you can take on risk in different areas. So, just because HEX is a way to produce yield that doesn't rely on some external factor, like the price of an asset or the interest rate that the market has set, the HEX is able to produce yield that other types of yield producing assets, the amount that you earn is peanuts compared to the risk that you bear in order to earn it. And so as HEX closes in on its first year of existence, you're already starting to see elements of that play out, where there's serious yield to be made in HEX, and the risk you bear in order to collect it. It's not like the type of risk that involves things that like that what just happened, where this yield, it was like one of these yield farm platforms. They lost $24 million because somebody didn't really hack, like they didn't like do anything that was like wrong or necessarily illegal. They just exploited in a smart contract that relied on external price feeds that this person was able to figure out how to manipulate. So they didn't hack necessarily this platform. They manipulated price using a technique called a flash loan to create the conditions so that they could pretty much just like milk this this arbitrage platform for like $24 million. Apparently they could have stolen all the funds. Like there was I just read this on Twitter. I didn't really look that deep into it, but apparently this person stopped at 24 million and didn't steal all the money. So it could be a couple reasons. We may have to make a whole video about how people actually like get away with money that people are really upset about losing. And then also I kind of want to touch on, when these things happen, it always creates a debate about who does that money belong to? Like, did the people who, risked their so much money in unaudited code, or, even code that was audited, but they still risked their money in this platform that somebody was able to figure out how to crack, like using the rules of the platform. Anybody could have done it. Like anybody in public could have, at any time executed this series of transactions that produced this. When these things happen and it's not the result of some type of deception where somebody, may like hack into your account to steal your money, or, even like investment fraud, like where people create they make up these crazy stories about, some DeFi product they're going to build. They raise a lot of money and then they just run off with it and then never produce what they said. Like, it's not even like that. It's where people figure out how to, pretty much just like, make excellent trades. That's really what it is. They're making excellent trades to accumulate that, and it usually comes at the expense of everybody. But it's within the allowed rules of these protocols. So it's not like they're hacking anything. They're just following the rules in a way that the people who tried to make these things secure and unhackable. Sometimes they just can't capture, like in their test cases, depending on how they do it. Sometimes they just can't capture every possible scenario, and so because these things like have never happened before, and so it's always interesting to look at these events because when things happen on large scales, they can have pretty big shocks to the prices of crypto assets. But then usually, now that this like attack vector has been exposed, in many cases, this type of exploit will no longer appear. And maybe that whatever Harvest Finance was trying to produce, maybe, like a next iteration will be able to produce it. And, the people who lost their money in that, those are just like those are the water buffalo that, they couldn't make it across the river, but since they tried, they at least like helped push the species forward because some, also tried alongside them and they made it. And, you never like, there's a lot of risk involved. Like, if, for people who are participating on like, in this emerging field where like this stuff has never existed before. So, like the people who are involved in this stuff, like they definitely are aware of the risk, but it's been pretty funny to see people that have lost money in these types of things, or just people who watching from the outside. They actually are like calling for things like chargebacks, or they're expecting the crypto exchanges to somehow like or just to block these transactions, or like trying to treat these funds as stolen funds, when in reality, like, because when you're entering in these smart contracts, like you're participating in them like under like software licenses that there's no liability, like nobody owes you anything. The code runs as it runs, and like in this setting, because these are bearer assets where the person who has the keys has the coins, and there's not like a third party arbiter to kind of settle this out. um, like it's been interesting to see when these things happen, people like kind of forget that these things are bearer assets and they should be treated that way. And having like the expectation of a bailout is pretty funny. It's like I understand. If you lost money because somebody, really just like a savvy software engineer, like that's who you're up against. Like that's why this is like a really hard market for people to people who may be sharks on even in like major investment funds. Like they probably can't compete with the the sharks that are trading in these markets. It's just different skill set, different different experience, and so it's all an emerging field, and so there's always opportunity. But the like there's serious risk involved in these, and usually people that are kind of calling for these for chargebacks, or expecting that someone's going to like prevent $24 million of crypto from like being moved around and potentially even sold. It's like the wrong expectation to get, and it's kind of like it's very counter to the things that are like really the real value proposition of cryptocurrencies as a means for monetary and financial innovation. And so whenever I see these happen, luckily I've never lost any money in this is definitely not like an area that I really dabble in. It's that's like a whole other thing But the performance that these people are looking for, like people that are looking to invest in these types of protocols, where the whole purpose is to produce yield, where you want to where the whole what they're doing is they're arbitraging interest rates across different markets, because that's one of the main ways that yield is produced in DeFi. So there's a difference between how you might think of yield and how you might think of like investment ROI. So a good way to think about it is that yield is so like yield is the number. So like how many units do you have? Like how many hex do you have? And then like the ROI is the how much the price has increased. So like the price per coin. And so what your effective ROI for a yield producing coin is, yield is usually 1% per year. The effective ROI is, the amount you started with, so your principal, times the yield, raised to how many years you have, how many years it was producing that yield, times, that's the times, principal times the yield, times the ROI of the coins. So like this will give you how many coins you have after producing that yield, and now the coin is applied to each of those, and like that's like your return. And so what that looks like in reality is like, if you bought let's say you bought 1,000,000 hex at 0.01, let's just make that at 1 cent, and then over a year you earned 20% yield, so now you have 1.2 million. Is that right? One more. 1.2000. Okay. So you bought that at 1 cent, and then now you have 1.2 million hex, and say during that time the price went up by say 50%. That's how much it's gone up in like the last week. But say it goes up 50%, so now the price is times 0.15, and so now what is that? 1.2 million times 0.015. That's 18,000 minus what you initially bought, which was 1 million, times 0.01. So you earned on a 20% move, your initial 1 million, 1 million hex that you bought at 0.1. So your initial $10,000 investment, it produced an 8,000, so an 80% ROI on only a 50% price move. So what this yield does is the yield, it amplifies the gain and helps limit the loss. Because say for instance, here, let's just go to the numbers. It's fine, yeah. So say for instance, so you have 1 million hex, 1, 2, 3, 1, 2, 3. And you have so you bought 1 million hex at 0.01. And then say over the first year, the interest rate is 0.2. And so at year 2, you're going to have this much. And then over this time, the price, say it increased by, so we just, calculated what if it increased. But say during this time, price decreased. by it decreased by say 20%. So say between now and the first year, price decreased by 20%. So minus 0.2. So now you have 120, or we have 1.2 million hex, but the price had gone down to, which would now be, if that decreased by 20%, the price would be that times 1 plus that. The price is now at 0.8 of a cent, and so your total amount is worth 9,600, whereas the amount that you put in was worth 10,000, and so the price went down by 20%, but the difference in the amount that you earned over that time is only 4%, because you earned because that difference is 400. You see that the difference between 10,000 and 9,600, so 400 over 10,000, that's 4%. So even though price went down by 20%, your the value of your holdings only went down 4%. And so that's really the power of this HEX stake, is that the price is quoted, it trades. Oh my God. Dear Lord. Wow, we're nearing all-time highs. We may hit 1 cent today. So shit, should we buy 1 million HEX right now to hold this example? We might. We just might. Wow, this is pretty remarkable. So what I was saying was that the price is set here, and this doesn't really factor in what the total supply is. The market expresses the price relative to the total supply, but when you trade it, that like people are looking at the chart and people are looking at the numbers, and people when they're drawing trend lines, they're basing it on the price chart. And so, gaining in both the balance and HEX that you have, it just helps you amplify your gains and limit your losses. So that I think is like a really powerful aspect of HEX. And what's different about how HEX produces yield versus other types of yield producing assets is that HEX issues the yield that it produces is entirely denominated in HEX. There's no external coin even related to how HEX calculates who to pay the yield to. There's nothing external that affects anything to do with the yield. The yield is purely produced by HEX. Like when the HEX smart contract runs, it looks deep within itself to calculate all like the state of all the stakes and all the coins, and then based on that, it allows addresses to mint a certain amount of coins into existence to keep the inflation at the constant 3.69% annual ROI or annual inflation. And so the only thing HEX relies on is itself, whereas other types of yield producing DeFi protocols, they have to rely on external forces, because the two main ways that yield is produced in other types of DeFi is either lending or providing liquidity. So lending is when if somebody has, like the lender has Bitcoin and the borrower wants to short Bitcoin, so they think that the they think the Bitcoin price is high, so they're going to borrow Bitcoin and short it. So what they do is they borrow Bitcoin from the lender. They say, I'm going to borrow, 1 Bitcoin, and I'm going to pay you, 12% interest to borrow this, whatever the interest rate is. And then the lender is going to make money by, lending and collecting that interest rate that the borrower pays. So that's one way to produce yield, is to put, if you have Bitcoin and you want to earn more Bitcoin, you can deposit on things like BlockFi, Nexo. There are others. And you can, post your Bitcoin, and it's going to be being like the service that you hold your crypto with. They're going to be lending it out, and you're going to earn some of that interest. And so that's one way. The risks involved with lending is that it relies on an active like borrowing and lending market, because you need customers. Like you have the asset that needs to be borrowed, and they're going to pay you for it in the form of interest. And so it requires that there's like a network effect of like active borrowers. And so that's a risk. Like it has to establish a user base, and it needs to be it needs to be able to be like interchangeable with like liquid markets, and all these things that make like a service like a valuable marketplace where there's enough borrowers and enough lenders so that an accurate interest rate is set. So that's one of the risks, is just that like a whole entire business case has to develop around whatever particular service that you're trying to produce yield with. So that's one risk. And then another form of risk involved in this is that you as the borrower are you have to hold, as a borrower, you have to hold your crypto with a custodian. So you have to give your coins to a custodian. So you introduce counterparty risk. So that's one of the main benefits of cryptocurrencies, is that they're bearer assets, meaning you hold them yourself. And so anytime that you give them to a custodian, whether that's holding them on Coinbase or whether that's posting your Bitcoin as collateral with Nexo or BlockFi, when you're going to borrow against it. And so there's counterparty risk involved in this, so that doesn't really impact the what yield is produced, but it does limit like how many people could might want to participate in these markets and pay that yield. So we'll focus mainly on what it is for the yield producer, meaning the lender in this case. But something that makes borrowers like less likely to do it is that like you have to hold your collateral with a custodian. But that's one of the benefits of using crypto as collateral, is that crypto as collateral is strong because it is very liquid. You can like instantly sell it on the blockchain, and you can and like the prices are pretty accurate because they're traded all over the place, and because there's like clear custody, like I said, it's a bearer asset. So if you have the keys and you can validate for yourself that you have those coins that you're holding as like your client's collateral, like you lent them money, they posted this collateral with you, you're holding it for them, and so there's clear custody. And the cost of holding it is tiny. You just have to have secure information security. You just have to hold the private key. And so, unlike other forms of collateral, like a house, like you can borrow against your house. Houses, you can sell a house, but houses aren't necessarily that liquid. There's the person living in the house. There's the person who owns the house. There's the bank that says they have title to it. There's the other bank that says they have title to it. There's the bankruptcy lawyer from representing one bank suing another bank who claims they have title. You know, there's not necessarily always clear custody of like who has it. Whereas like in crypto, if you have the keys, you have the coins. So there's clear custody, and then the cost of holding it is tiny. You know, you don't pay anything to hold crypto. So it's like a really strong form of collateral, and so that makes it a really good thing to secure a loan against. So from the borrower's perspective, it's a strong it's a good collateral. Or I mean, so from the lender's perspective, it's a good collateral because it has these qualities. And then, so just lending your coins and earning interest, like people, probably a good rate that people go for is like 8% per year. But that's like pretty, that's really high. And you have to give up a lot of risk to do that because you as the lender, you're actually, you're not in possession of the coins either. They're on the platform that you're lending through, and there's counterparty risk involved there too. And so in some cases, giving your coins to be lent away, it introduces counterparty risk, and so that 8% yield that you get is diminished by the amount of risk that you have to bear in order to earn it. And so the lending is pretty difficult to do like through centralized parties, but something that's emerged like are these platforms like OV, where you can actually it's a non-custodial protocol. So this is done through a smart contract. And so that's kind of, there's the centralized ones like Nexo, and then there's these decentralized ones like OV. And what, so this reduces the counterparty risk. But, when you're locking up your funds so that they can be lent out, you're not executing on other opportunities. So there's also opportunity cost in there. But lending, where the risk that was introduced with this one is that, and this has happened in ones in the past. These lending protocols, they rely on external price feeds to tell them exchange rates between the currency that was lent and the currency that was posted as collateral. They rely on that to measure the value of the collateral, so that if the price reaches a level that is below the collateral requirements, like if the value of the collateral decreases relative to the amount that is owed on the loan, if the value of the collateral decreases faster than the loan is paid off, to whatever threshold is the minimum that they agree to when they issue the loan, it'll start making payments, and so the lender will end up be able to take possession of the collateral because then they sell it usually to cover the loan, and so with these as a lender you can earn yield, and it all just comes down to whatever the market pays. These lending protocols have these mathematical equations that set interest rate based on how many people have posted money is available to lend relative to how many people have posted collateral to borrow. And it just, kind of does this like automated market making to set an interest rate on these loans. And then the loan is executed entirely through a smart contract where you send your collateral to the you enter the collateral into the smart contract, and then you get a transaction into your wallet of a stable coin that you're borrowing, and then when you pay it back, you pay back the stable coin through the smart contract, and then it unlocks your collateral back into your wallet. So it's good that there are these options to earn, but they have to rely, like when they're measuring the value of the collateral, they have to look at price feeds through these price oracles. And the problem with oracles is that sometimes they could be manipulated, or like the way that it like makes the calculation on what the collateral requirement is. Sometimes that can get disrupted. Maybe in this case with Harvest, somebody was manipulating the interest rate on something that triggered something to enable them to withdraw infinite money effectively from this it's this DeFi service. So having to rely on these like third party like data sources, like having to read an interest rate from some other protocol, or have to read the exchange rate from a trading pair. There can be vulnerabilities that only get discovered once it's too late, and so you trying to earn yield in that way, it introduces that type of risk. And like the other day, people lost all this money to that, where they're trying to earn yield and it bit them in the butt. So that has to do with lending. The other way to produce yield in DeFi is providing liquidity. So that's like a different type of lending. What it is on Uniswap, where these coins are traded. What it is it's entering a smart contract where you're going to provide liquidity for a trading pair. And the way you do that is you put in an equal amount of both currencies. So like right now, the exchange rate is like, let's see, let's see what it. Okay, here we go. So like right now, there's 653,000 Ethereum and 265 million Tether. And so if you were to put, if you were to contribute to this liquidity pool, you would put an equal amount at this exchange rate. So at this ratio, you would put an equal amount of the wrapped ETH, so the trading ETH. You put an equal amount of the ETH to the Tether, and and then that goes into the liquidity pool. And when people are buying and selling, so like right now, like people who are selling HEX, they are selling in. So here, let's look at the HEX. Where's HEX v2? Oh, this doesn't show the. Let's try to find it. Let's take a look at the HEX Uniswap. Should always check the contract, B591E. Yep. Okay, here we go. So there's like 4 million in liquidity in HEX. And so that would mean that you're putting so you would put in $1,000 of HEX and $1,000 of ETH. And what you're earning is you're earning a transaction fee. And so it's a way for people to kind of like monetize their coins by acting like an exchange. Like the exchanges kind of make money on this spread, where like, they're the ones that are providing liquidity. Like the exchanges typically run trading desks where they have people who are like, in there so that, the price isn't too volatile, and, there's always liquidity when people want to sell and they don't push the price around too much. So the exchanges do that. In like the real financial world, those are like actual, they're people that get paid to do that. Where they get affected, through like having like no fee at all. they can just like trade and make that tiny spread because they're helping stabilize the price and make sure that there aren't like these like crazy wicks that people can like take advantage of. So like market makers are like a really important part of financial markets. It's what helps keep the price, not too crazy. And so that's what you're doing when you're being a liquidity provider. Is you're putting in an equal amount of two currencies, so that and you're earning a transaction fee. And so let's see what the transaction fee. So in the last 24 hours on, the liquidity pool has earned, $7,755, and they're holding 7 million. So over the last 24 hours, they made 7 over 7,668. So over the last 24 hours, they made, 0.0009. So let's round that up to there. Round that up to point. Yeah, because it is high. It's like 7.7. Okay, so they made like, that 0.1% fee. But over a month, that is 3%. So, but that's like one, in this setting, they're earning 3% per month times 12. And that's 36%, like just like, but that's not actually what they're earning, because in providing liquidity, one of the main risks is it's called impermanent loss. It's what, because you're like, as a liquidity provider, you're the one that like someone is selling to, and you're the one that someone is buying from. So like right now, like these people who are like selling or buying, like if we zoom into the 1 minute chart, like, these people who are selling and these people who are buying, the buyers are buying from the liquidity pool and the sellers are selling into the liquidity pool. So it's not like a buyer is buying from a seller. The buyer is buying from the liquidity pool. And so when that happens, like you as the liquidity pool provider are, you're selling all the way up. So maybe down here, you would, had, because the price was lower, you had more HEX per ETH. But now that the price had gone up, you now have more, you gained ETH because there are more buyers pushing price up. So the buyers are coming in with ETH. So after some time, now you have more ETH, but you have less HEX, but the HEX is more valuable. And so, you earned transaction fees over that time, but sometimes you can lose, if price just like continues to go up, you would have been better off just holding the coin, because during that case, because you have to put in an equal amount of HEX and an equal amount of Ethereum, you missed out double, because, at the start you could have just put that, you could have put that ETH into HEX, but instead you split it up where you had to have equal HEX and equal ETH to contribute to the liquidity pool. So over this month, okay, that's over 24 days. It earned that, so over that 7 days, it's earning like just under 1% yield. But during that time, the price went from 50 all the way up here. So the liquidity providers here probably didn't, like you as a liquidity provider lose money when the price is up. Like price is gonna have to go back down, like this same exact thing where like they had, they started with more HEX, and then as the price went up, they had less and less HEX. To kind of make up for that, like price needs to kind of range back down. And so providing liquidity is most profitable as a yield producing asset when it's best when it is a stable coin. Because when you're providing liquidity, you lose money when price goes up and you lose money when price goes down, but you make the most money when price remains constant. Because as both sides of the coin, because you have to have both coins, in a stable coin, since they're not really changing like the amount that they are worth relative to one another, um, they are you're not losing that money to, it's called impermanent loss. And so as you're accumulating the fees, the liquidity pool just like grows and grows and grows. And so stable coins are good for that, but it doesn't, because like there's like it's a stable coin. Um, the fee is really low. Like the market has really low tolerance for fees, and so in order to produce like meaningful amount of yield, you just need to have large amounts of money. Like if you're earning 1% on $100 over a month, like earning $1 on $100, like that's nothing relative to what you could earn in other investments. But if you have say like $1 million, like 1% is $10,000. And so, is that right? Uh, yeah, like 1% is $10,000, and so that's like meaningful income that can cover like real expenses. But like $100, including the gas fees, because to enter these contracts you have to spend money, to exit them you have to spend money. Like you with a small amount of money, you're not going to earn much yield providing liquidity. And so, it's best when it's stable, and it's best when it's in large amounts. And so, so providing liquidity, like, that's like another tough game. It best works with like, if it best works if you're able to borrow at a really low interest rate and then provide liquidity with that, with like the coins that you're borrowing. That's kind of like at the core of this whole, like yield farming, economy is, borrowing at a rate here and then, earning yield on that in this other way. And then whatever that difference is in the amount that you're earning relative to the amount that you're paying for borrowing it, that's your profit. So that, that's just a tough game that like really sophisticated players are playing, and, they're going to take your money, and, that's what happens. So, just as like if you're like a real shark and you have a lot of money, there's definitely opportunities in these areas. But for like smaller amounts, you want to stick to things where the only risk involved is the exchange rate risk. Like if you can hone in, like you can like reduce other areas of risk, like custodial risk, where you have to have someone else, hold your money for you, or counterparty risk, where someone that you're relying on to like, tell you how much inflation to mint. If you have to rely on some external force, that type of risk, like eliminating that, eliminating, the risks of, having to have like an entire like business use case built up, like having to have like borrowing and lending built up around the platform that you're providing yield on, and maybe the platform that you're trying to earn yield on gets out competed by another one. And now you as the so you as the lender earning yield, like your customers go away. So like you have to, it disrupts your business. So like, these other risks, as a small player, you don't want to bear those risks. Like you as a small player, like you want to focus in on the exchange rate risk, because that's the one that can most work in your favor. Buying low and like, riding a massive move up, that like, can, like you as a small player, that's like something that you can do, and with like the least barriers to entry, the least barriers to success, like making money in these like more sophisticated financial markets. It's not so easy. Like your loss is their gain, in that case, and but buying something when it's underpriced, and then earning yield on that, and then especially if the way that the yield is generated helps support the price. Those are the things that like, you can turn small amounts of money into, significant amounts of money. And it just, like that's what's so great about HEX. Is it just involves so much less risk, because the only risk involved is the exchange rate risk. Because in HEX, the yield that is produced is calculated entirely from information that is part of the HEX protocol. When you stake your HEX gets converted into shares, and these shares, account for how long your coins are locked. And when your coins are locked, they're burnt. And so what this, share system does, where you stake your coins, and then when you end your stake, you can remint your coins plus some interest, such that it hits the target inflation rate of 3.69% per year. The only thing it's relying on is information that's in the HEX system. It doesn't rely on like some external price feed. It doesn't rely on some type of lending market to emerge. It's purely from within. So like everybody on Earth could just go away, and like HEX can continue to operate without any human function. Like there's no one that can shut this off. There's no one that can just like change the keys and run off with all the money. Like all the money that's owned by every address is rightfully that address's. Like there's no like admin keys. There's no like, you're not contributing your money to a pool. When you lock your coins, you burn them. Like nobody can use them, and the only one that can remint them is you. And so it just like reduces these forms of risk that are present in these other coins. And it's pretty interesting to see that a lot of these ones that get like widely promoted by kind of like the mainstream, it's not mainstream at all. Like crypto is definitely on the fringe, but like the mainstream crypto people, and like publications and like platforms, they just like, they just have so much hatred for HEX, but they like always latch on to the hot new DeFi thing. And it's, some of the DeFi things work out, but like it seems like maybe 2/5 of these things or more of the ones at least that get like heralded by the mainstream crypto people. So many of them, it seems like every other week there's one of these exploits. Harvest lost 24 million because their code just had a weird little bug. Remember a couple months ago that whole Yams debacle, where the first day of this like brand new reflexive supply currency, they realized that they didn't do their math right, and it was going to print too many coins and lock the whole system up. What else? What's another one? There's another one with like flash loans, where like I think a teenager like was able to manipulate the price oracle and then ran off with a bunch of money. Sushi swap, like it's just a classic rug pull. So like having to rely on these like external things is like a major source of risk, and time again they cause people to lose money. And the people that promote those are the same people that try to either act like HEX is a scam, or now they've started to move to like, oh well, I'm interested in seeing how it works. I still don't think it's a good investment, or HEX may not be a scam, but it's probably not a good investment. When you just look at the chart and you just look at the how during a time of hyperinflation, where HEX is, a time of hyperinflation where, HEX is like having, its first year launch, going from zero supply to like the first, supply. We still have massive price performance. And on top of that, it's earning 24% annual yield to the average staker right now. And that yield is paid from non-stakers to stakers. So everyone who's holding HEX, they're the ones paying the stakers. And so it puts this incentive to stake your HEX. And so what that all adds up to is that, in HEX, the yield is only produced from how itself is operating. And it doesn't rely on any external thing to happen in order to produce this yield. and compared to other things that like are loved by all the mainstream crypto people, those things lose people money, and because the yield is only produced because of a very risky activity, and in these cases the risk outweighs the reward, because like you're likely to lose $24 million to someone who manipulates the code. And so HEX produces the yield through a completely like internalized process, and so it eliminates entire classes of risks. Because the only risk in HEX is the exchange rate risk. That like what's the price going to be? Is the yield? Say you earn a compounding like 24%, APY on your HEX stake for 5 years. So if you're like, say you have this can be rough hand because this isn't how it's calculated. It's just estimate. But say you have a million HEX, and you times and you're earning 1.2. So say it's earning 23% interest. Let's see what the interest rate is right now. Does this one show the... Wow, number 10 crypto, $3.5 billion market cap, $5 million staked for an average of 4.42 years. So right now, the average stake, average length, average size staker is earning about... They have it locked for 4.42 years. And... so the interest rate is, where can we find this? I think on hex.vision. Let's take a look at the block might tell us. Let's take a look. So we can be accurate here. Okay, here we go. So right now the interest rate is 28.993%. So this is the so where this number comes from is that so 12% of all the HEX is staked. And so that means that 87% is not staked. And so all of the new inflation, so every year it's 3.69%, so 0.0369. So every day that is about 1% of a percent. Gets paid to the stakers, and since that 1% of 1% is only being paid to 12% of the supply, let's see if so like that daily inflation is being paid to only a small piece of the supply, and so all of those people are like in aggregate they are earning an annualized 28% per year based on how much they're earning per day, by being part of the staking group that earns the inflation from that day. So if this was 100% locked, because the 100% locked to 0% locked, the number of new HEX minted per day remains what it what the calculation produces, and so if everyone is staked, the inflation is distributed amongst more people, and so it's closer to that 3.69 annualized percent. But if less people are staked, you get more of that constant inflation pool, and so you earn more than the 3.69% target rate. And so right now, because only 12% of people are staked, that goes to like that interest rate for the average, the average staker is 28% per year. So people that are staked So these people right here, like this is like an average staker, the 4.42 years. So if they're earning 28%, so 1.28 to the 4. So this person is going to be earning, so if they start with a million hex, they're going to end with 2.68 million hex. Because if the staking percentages stay where they are, as more people stake, the amount they get is less. But since they locked in their stake before, they always have an advantage to stakes that start later. But extended over the 4 years that these people are locked, those people are going to earn pretty high yield on that average length stake because so few people are staking. And so that's one of the benefits is that if the that no matter what that number is, no matter what percent of hex that is locked, it can work in your favor. When there's low stake percentages, then there's more coins on the market, meaning price can go down because there's just more hex available to sell. So that can hurt price. But during that time, if you have stakes, especially long stakes, you earn a disproportionate, a large amount of hex per hex that you have staked. And so when the percentages are low, you can earn more hex. But when the percentages are high, meaning the inflation pool is paid amongst more stakers, that you earn less yield, but the value of the yield you're earning increases because there's less hex available because it's all locked in the stakes. And so I it's only been around for a year. It started in the early days. The true believers were trying to get their long-term stakes locked in at really low share rates. And so the staking percentages in the first couple of weeks was something like 75%. But now that there's been so much of the inflation over that first year that's come through the, let's see if we can pull up that. So there's been so much, inflation because of the launch auctions, that the total and because the price has been pumping, there was a high stakes, or a lot of people were staking when the hex price was just kind of chugging along down here, not really pumping. But as soon as it had its first couple 1,000% move, a lot of people just wanted to have hex available to sell, and so the stake percentages went down, and just because there's so much hex coming on supply, that's just what the number is, and so I think leading up to the end of the launch period where there's the big payday, we're going to see more more people staking, but for now at the current rates, you're earning 28% yield in hex, and during this time, price is busting through all-time highs. This is remarkable, and so because of those properties, the only thing you have is exchange rate risk. But because there's high exchange rate risk, there's also high reward. It can create this scenario where your hex is earning yield and the hex is going up in value. So your balance goes up and the value per unit goes up. And so that's a major type of reward, is that you can compound your gains and you can minimize losses. And so that's what's really exciting about this. I wanted to talk about what makes HEX a strong form of collateral, because this really kind of fits into that. How HEX produces this yield, and by producing the yield, it helps you offset different types of risk. And tonight I wanted to talk more about how HEX could be a type of collateral for lending, because you can counteract some of the risks involved in lending by earning yield during the duration of the loan. Um, and so I wanted to talk a little bit about that tonight, but I don't think I'm gonna have time because I think I went too in detail. But um, this was a pretty interesting thing to see play out, because we've been talking about this for months about how you know a lot of these things are really risky, and sometimes things can get messed up. But at the same time, Hex has really emerged in DeFi. It really kicked off the DeFi cycle. And then while all the other DeFi products were having their heyday, between May and September, Hex had its first 80% bear market, over 3 months, 4 months. So Hex has really been through a lot, and as all these DeFi products that were getting a lot of the economic energy have started to die out, Hex has continued to go up in price, continue to print yield for the stakers, and while all these other things are just one after one has just like collapsed, and so I think that I definitely think this trend is going to continue, where where Hex is going to continue to be a way to produce yield, while alleviating different types of risk involved in these assets. So that'll be all for tonight. We'll continue to touch more on this topic in the future. But thanks for listening. If you have any questions, just put them in the comments, and we'll try to get through that. But yeah, until next time, thanks for joining.